Hello guys, welcome back. This is David. I hope you're doing well. Let's check out the next one here. Credit analysis for corporates. Now, the theory of credit risk and all the terminology is back. So the capacity to pay is the ability to pay us. And we want to make sure that they have enough, of course, profits and also enough cash flows to make our payments, the interest and the principal payments. Now, the theory of losses and the theory of default comes in here as well later on. Going to look at the factors that drive the PD, the probability of default, are factors that drive the loss given default. Remember, guys, here that the loss given default also is 1 minus the recovery rate. We're going to be looking at recovery rates later in this reading as well. Now, when you combine the PD times the loss given default, well, we have an estimate of the expected loss. Just bear in mind, guys, there that we can turn that into dollars. We put some exposure on the end of that, or we can keep it as a percentage as well. And remember that the word expected in the risk world means that the most frequently occurring loss. So it's not going to be the worst case loss. It's a very much a high frequency loss that you should expect. I feel like it comes with the territory. Let's check it out. Now, gonna start to analyze these credit risk factors, but what I thought I'd do is just to remind us from an earlier reading, the credit risk reading, of some of the theory. So we have got, firstly, guys, there, I put in the 5 C's of the bottom-up credit factors, like the capacity to pay and the character or the willingness to pay. So in this reading, we're going to look quite a lot at some of these factors, starting off with our qualitative factors here, looking at the ability and the willingness of companies to repay us. Now, sometimes it's going to be secured, sometimes not secured, mentioning collateral here. Thinking about capital levels of the corporate as well, and also the conditions or contract, here the bond indenture. We've already had a look, guys, at the affirmative and negative covenants, things that they promise they will do, things they promise they won't do, the conditions that protect the bondholder. Now, on the right-hand side, we've also got the top-down credit risk factors, more C's here, the economic conditions. Now, we know that this impacts companies to different degrees, depending if you're perhaps investment grade or if you're high yield. But the impact of a downturn, particularly affecting those weaker companies, of course, also might impact certain industries more than others. The country that you're in, the region that you're in, the market that you're in, impacting by those wider factors as well. And also currency. Are you lending in a particular volatile currency as well? So what we're saying here is these factors are still at play, and we will notice reference to them as we move into this new reading. So starting off then here, the analyst will use both the qualitative and the quant, the numbers factors, when looking at the likelihood and the impact of default. Now, in the risk world, I mentioned about the language changes depending upon the risk. Here in credit risk, it's very common, of course, to use the terms PD, or probability of default, and loss given default. So when we talk about the likelihood and impact, much more commonly, we will refer to PD and loss given default. Now, the probability of default will depend an awful lot. Is it going to be investment grade, or is it going to be high yield? Also, of course, meaning that the credit ratings are driving things. Stronger rating, the PD is going to be far lower. Weaker rating, PD is going to be far higher. We're going to talk about the loss given default as a percentage, and that's going to depend a lot on the recovery rate. So if the recovery rate here is only 30%, then the loss given default is going to be 70%. And that's going to depend a lot on the ranking. So if you've got a senior ranking or some sort of collateral or security, you're going to get a lot more back. If you're much more junior or subordinated, you have to wait in line, and your loss given default will be far higher. Let's check out the factors then here that are driving PD and are driving loss given default. Well, starting off then here with the corporate